somebody who starts out as an active investor, which I absolutely encourage folks to become an active investor, because when you own your own investment property, you learn so much, like everything from, the contracts, how to lease, how to deal with tenant issues, how to deal
Yeah.
with insurance issues. You learn so much that carries over to if and when you decide to invest with a syndication, because now you've been educated as a real estate investor of your own, having your own property.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cashflow podcast. I'm here with Tony Lopes. Tony is a CEO of Dirty Boot Capital. We'll touch base on that name later on. He's a real estate professional, author, coach, and speaker. He worked in defense industry for 19 years, managing multi-million-dollar program, while simultaneously building a portfolio of residential income properties. His investments, coupled with his understanding of markets and economics, allowed him to retire at age 44. And today he plans to share his experience and knowledge so that others can achieve the same level of freedom as he does today. Tony, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Thank you for that very kind introduction, Ted. It's a pleasure to be here, and I'm really looking forward to the conversation here. I think we're going to have a lot of fun. We're going to add a lot of value for your listeners and for your viewers. So stay tuned, folks. This is going to be a wild ride.
That's for sure. Yes. So, so Tony, before we get started into the niche that in your niche, right? If you can give our listeners a little bit background about yourself, how did you get started into real estate, and what's your main focus as of now?
Yeah, good question, and it's a very good place to start, especially maybe for your listeners and your viewers, because maybe I can resonate with them. I come from a family where my parents were immigrants. I'm first generation. My parents were immigrants. They came to this country, saw so much opportunity, and so their mantra here in this great country, they told me and my siblings, go to school, get a good education, you'll get a good job, and you'll be good forever, right? That was the mantra we were given. And so what did I do? I was a kid. I didn't know any better, right? I listened to my mother and my father. I went to school. I got a great education. I got a bachelor's of degree in mechanical engineering, right? So a very good degree today. And then I also got an MBA, right? So I had a great degree. I went to go work for a great company. That worked for 4 years. And then I got laid off, right? And that was never part of the mantra that my parents laid out for me, right?
Yeah.
Being laid off was never part of the plan. So for me, that was a wake-up call as a well-educated young man, as someone who just entered the working force. I was like, holy cow, laid off. What do I do now? So I wasn't financially independent at that point. I had to recalibrate, and I had to find another W-2 job, which was okay. But after I did, very shortly thereafter, I said, I need to do something different, because I don't want to be at risk of getting laid off again. I want to have more control of my free time, of my cash flow, and of my life. So I quickly got into real estate, something that I know a little bit about. My parents did a little bit of real estate investing, so I knew a little bit about that, enough to be
Mhm.
dangerous, I say. So I purchased a 4 unit, right? I started, small. Some people today, they'll look at me and they'll say, oh, you must have come from money. Had millions of dollars. And no, I didn't. I started off very small. I owned a condo, which I had a mortgage on. I was able, fortunately, to do a refi on that, get a little bit of cash out of my condo that I was living in while I was working. I was still working at that time. I bought a quad, a 4 unit building, and I property managed it myself. I handled everything myself. and I was able to cash flow. And so from that quad, I ended up buying a 3-unit apartment building, and then a 2-unit, a duplex, and then a 5-unit. And so I really started off, rather small.
Mm-hmm.
So for folks who, this is real estate investing is not a sprint, it's really a marathon. You know that, Ted.
Yeah.
I know that, right? But if we look and say, where do we want to be in 5 years or 10 years? Uh, some of this financial freedom is truly possible and doable if we think of this more as a marathon and take some steps towards that, as opposed to a sprint. Like we hear on social media, sometimes social media, all they want to show is the very sexy, Lamborghinis and beautiful houses. And,
Yeah.
it doesn't start that way.
Yeah.
Again,
And
I was living
most
out
of
of
them
my
is not true also. Sometimes I would say
true.
just don't get
You're right.
yeah.
Yeah, so that's a little bit about my backstory, which again may resonate with your audience. I come from a technology background of working in corporate America. And then I got to a point where I had enough real estate where I was able to, as I say, retire at the age of 44 from corporate America and just do real estate full time.
Yep. And you rightly said, right? It's not a sprint, it's a marathon. But people need to understand they got to start at some point. You don't expect to buy like a 50 unit, 100 unit at the first deal. Yeah, just get started. Get to know the game, get some experience, and you can always leverage that experience and build a property portfolio based on it,
Yeah, and it's so much easier, I find, looking back on it, when I started 20 years ago, I didn't have all the beautiful things we have today. Like when I look at it and I speak to investors who are just starting out, and I was just chatting with a 26-year-old investor. He's looking to buy his second multifamily. Man, I'm so proud of him. He's doing really well. Um, we didn't have social media 20 years ago as a networking tool, as a education tool to be able to, if we had a question, to be able to ask a forum of other investors, how do you deal with this tenant issue? How do you deal with this property management
Yeah.
issue or this insurance question, right? I mean, today we have that as such a great resource to leverage the knowledge of hundreds, if not thousands of people in that community. So that's huge today and makes real estate investing easier today. The other thing is, back then we didn't really have so much like, if you wanted to get into real estate investing, for the most part, you had to be, unless you were investing in a REIT, which doesn't
Yeah.
provide the full benefits of ownership, you had to go to loan and be an active real estate investor, which is fine. That's how I got started.
Yeah.
Buy your own building, manage it, deal with tenant issues, deal with contracts with contractors. You had to really do active management of your investments. Today, we have these great things called syndications or investment funds that will actually invest in properties that either you pre-selected or that you trust they're going to buy the best property via a real estate investment fund. So today, I mean, and I'm not saying one is better or worse than the other. We just have these different options that weren't available to us really 20 years ago. So now people have the opportunity to invest in real estate either actively and go off and buy their own real estate and grow their portfolio themselves, or
Yeah.
invest with a syndicator or with a fund manager to go off and buy real estate with their help, so to speak, with other
Yeah.
limited partners and whatnot.
Yep. And and the beauty of it is, in the passive investment, the syndication, right? Uh, you don't have no headache. You don't have to go find a property.
Yeah.
You don't have to maintain the property, but you get all the benefits of investment, including the tax, depreciation, everything, right? So it all
Yeah,
depends
right.
on the person who wants to invest, how much time he has. If he has more time, he can actively participate in the real estate deals. If they don't have much time, they are much focused on their other 9 to 5 or job or any other professional, doctor, engineers, whatever they might be. They don't have
Yeah,
time
and
to
you're
look into that, then maybe just invest passively.
And with syndication, and this isn't, for the listeners and the viewers, this isn't, just a syndication, pro syndication, go invest in syndications,
Yeah.
where Ted and I aren't here for that. We're just trying to identify some of the pros and cons, so to speak, of active versus passive.
Yeah.
Some of the, like you're sharing, the pros of investing through syndication. Like I'm looking today, if I want to invest in other asset classes like storage units
Yeah.
or medical office buildings or retail, that really hasn't been my swim lane. I'm very true to my swim lane of multifamily residential living. That's what I
Yeah.
know. I know it well. And we do great with multifamily residential. But you know what? If I wanted to go into storage unit investing, I don't know that, right? Like, can I learn it? Sure, I can. But to be able to leverage a syndicator who already has cracked the code and knows the recipe, I would rather team up today with a syndicator and be able to co-invest with them, because they already know it. So
Yeah.
that's the part of the beauty of, the syndication piece. Yeah, and you're right. You get the beauty of, um, and things change over time. Like somebody who starts out as an active investor, which I absolutely encourage folks to become an active investor, because when you own your own investment property, you learn so much, like everything from, the contracts, how to lease, how to deal with tenant issues, how to deal
Yeah.
with insurance issues. You learn so much that carries over to if and when you decide to invest with a syndication, because now you've been educated as a real estate investor of your own, having your own property. You now ask more important, like I'll have investors call me and they ask such great questions. I'm like, you must own property yourself.
Yeah.
Many times they do, and they ask these great questions, of the syndicator, of the sponsor. So getting into the active piece, I think, it can be a very important step for folks who want to actively manage, because they become better limited
Yeah.
partners when and if they go into a syndication, which most times active investors do, because as you and I know, Ted, um, in our lives, as we build up cash flow is great. But one of the things we hate to do as real estate investors is we hate to pay taxes. And we get with our own properties, we tend to get maxed out on our depreciation.
Yeah.
And so we need another thing, another asset, could be storage units, could be multifamily or retail. We need another asset to offset that income with this great thing called a paper depreciation. And oftentimes we get what we need in the form of a depreciation through a syndication that is just purchased like a large multifamily building, and then we get the benefit of that cost segregation study and that benefit, the depreciation that comes along with it. So again, these are all just like little talking points that hopefully are helping the viewers understand how we piece these things together.
Yeah. And as you mentioned, hands-on experience is always valuable. Once you have a small property, you know in and out how to manage, how to take care of it, what are the pros and cons of owning a property. You have dealt with bank finances. If you have a mortgage, you have, done all your paperwork, and that experience helps you, uh, you know, that experience you can leverage uh, to partner with any other syndicator, because you know the basics. Yes, there is some more into it, but at least your groundwork, your bases are clear, and you'll be able to understand and ask more questions to the firm or the syndicator you're working with.
Yeah, and then, one of the things I share with folks, we're in such a we have, as real estate investors, we really have to have more of a macroeconomic sense of the ecosystem we're
Yep.
we're in. It's not just, you know, looking to fill units with renters. We need to understand what's happening in our location. Are there jobs? Are there jobs coming in to this location, or are there jobs exiting this location? Maybe some businesses closed, right? What's
Yeah.
happening there with the economy locally? Are they building schools and hospitals and things like that, and universities and extension offices? That's a sign of a very healthy, vibrant community that's growing. If they're building these things, if they're building
Yeah.
new roads, expanding highways from a 2-lane to a 3-lane highway or something like that, right? These are all signals of an expanding location of a market we want to be in. So as an individual active investor, you start to realize these things. You're like, why
Yeah.
is it so hard for me to rent today? And so you start to pay more attention to news articles and the media, your local media or your local newspaper. You just start to organically start to understand these things better. And so then when you start working with a syndicator, that knowledge transfers, right? All that
Yeah.
knowledge that you had, it's not lost as an active investor. That all transfers over to a passive investor because now we ask these questions. What's happening in that location? Is it growing? Is it contracting?
Yeah.
Are they adding schools? Are they adding, new hospitals? Like I'm in an area down in Florida where they're building a brand new hospital and they're adding university locations. And you look at the road work, the infrastructure that's going on, the bridge work, it's massive.
Mhm.
Billions of dollars is going into this location. And so I look at it and I say, that's where I want to be. So this it's all transferable. So I don't want anybody to feel bad
Yeah.
to say, oh, I'm an active investor or I'm a passive. No, I mean, there's something to learn on both sides of that equation.
Yeah. Yep. So let's switch a little gears. Okay. First of all, I'd like to know, how did you come up with the name Dirty Boots Capital?
That's a great question, Ted. So when I was young, my parents, very blue collar. They were immigrants again, to this great country, and so my father did road construction. Always came home with his boots dirty. My mom always yelled at him, "Don't walk on the carpet. I just cleaned, right? Leave your boots at." So, but he also did a little bit of real estate investing. So he got his boots physically dirty, remodeling apartments, right? And doing stuff like that. So he always had his boots dirty, literally. The same with me. When I got started with my real estate investment career, I
Yeah.
got my boots dirty doing remodels and, landscaping and different things like that. I built some spec homes along the way, so I'm walking in dirt and whatnot. And yeah,
Mhm.
always got my boots dirty. But the more I got educated and the more real estate investing I did, I realized as investors, we need to get our boots dirty in a lot of different ways, not just walking onto a construction site or walking onto a remodel site. We do get our boots dirty doing that, but we also get our boots dirty walking through financial statements, making
Mhm.
sure the financials are in order, walking through demographic reports, understanding what the demographics look like in that location today as well as the future, looking at migration reports, right? Some of these U-Haul articles and studies
Articles.
that come
Yeah.
out that say where people are moving to. We want to look at those migration reports to understand we're investing again in a healthy, vibrant location and state. So we get our boots dirty, not just in a literal sense of on the ground getting them dirty, but also as we walk through financial statements, demographic reports, migration studies, right?
Yeah.
There's a lot these days to make sure we get it right because we're dealing with investor money, right?
Yeah.
Uh, we don't want to go back to investors and ever say we screwed up. We
Mhm.
want to protect those investors. That's what we're here for. So we do our due diligence a number of different ways, and so through it all, that's how we get our boots dirty here at Dirty Boots Capital.
Mhm. Yeah. Interesting. That's pretty pretty good name and, catchy name, I would say.
Yeah,
Yeah.
yeah, because I think sometimes we get we can get stuck looking at just the project itself. Like I know you do some ground up construction, and yeah, we want to be able to walk that site and understand what the project is about.
Yeah.
And sometimes it's easy to get stuck in that, looking specifically too much at the project and not the macro picture of that area and location where you're at. So we want to make sure we talk to investors about the whole picture, make sure it's healthy for them.
Yeah. And not only the area, and I would say, just to add on what you said, right? We as a syndicator, we also look at the future prospect, how we are going to add the values to these properties, how we are going to bring up the rents, how we are going to increase the NOIs, decrease the expenses. So there's a lot of work that we do to make sure that we try to meet our investors' expectation.
Yeah.
Yeah.
Yeah, and there's a lot of momentum these days when we look at the macro space. I talk a lot about renter nation, and it's something that, I hadn't really considered until about, honestly, probably about 4 or 5 years ago. So I started researching a lot of different macroeconomic themes.
Mhm.
And so uh, I started to write a white paper on just some different topics that I want to share with some folks. And I thought it was going to be like 20, 30 pages. It turned into like 200 pages and it became a book. So I wrote a book called Freedom at Risk: How to Protect Your Personal and Financial Freedoms. It's not a plug. If you go and buy it, great. Thank you. I appreciate it. But really, I bring it up because it taught me so much about the macro trends of things and why we are in such a renter nation these days, which means renter nation means a nation where there's more renters than there are home
Owners.
owners,
Yeah.
right? So we have so many different trends politically, um, from a societal standpoint, things that are driving us towards that. We have energy factors. Energy is becoming more expensive, which means it becomes more expensive to run a home and own a home and repair a home. So there's energy factors that are going into that. So yeah, and I talk like for an hour, if not more, just about renter nation. But this is one of the things we do for investors, is really understand, like you say, and we look in the windshield
Yeah.
and we say, what's going to happen in 5, 10, 20 years? And we invest accordingly. And
Yeah.
so now we see they're becoming more and more renters than
Yeah.
owners. That's just a trend for a lot of reasons. It's not just interest rates are high and home prices are high, but it's also societal type of factors. When we look at where people are today, and this isn't I always preface it, so to speak, with this isn't good or bad. I'm not bashing millennials or Gen Z. I'm not. They're coming into a world where they want and need immediate satisfaction for
Yeah.
certain things. So they grew up with Amazon. You order it one day and it's on your doorstep the very next day. It's
Mhm.
this immediate satisfaction that they've grown up to know and love. And that's okay. That's their world. But when it comes to the weekend, they want to be able to go enjoy the weekend, whether it's outdoor activities or seeing a movie or spending time with friends. They don't want to spend, for the majority, it's not everybody, but for the majority, they don't want to spend the weekend cleaning gutters, mowing the lawn, or painting trim on the house. That's just not how they want to spend their weekend. So
Yeah.
that pushes them more and more into that renter category for longer,
Yeah.
right? And then we also have societally, we have shrinking family size. We no longer have, a husband and wife and 2.5 kids. We don't have that anymore. We have more single people, more single parents with one kid or two kids. It's a smaller living arrangement. So that gravitates more towards renter than owner. So there's a lot of different factors pushing us more towards a renter's society.
And they have a freedom of choice, right? They can move to different locations anytime. They don't have to worry about selling the house or apartment and then buying it at a different place. It's just, they make the decision and they move on. And
And
because of the current IT technologies, right? There are so many options to work from home. So they can just go to a beach, work from there, come back. So it's a lot
yeah,
of flexibility that they
yeah,
want.
the that work from home culture that was created during COVID, that's not going away.
Yeah.
That's something that, some companies see as a benefit to be able to attract and retain the best workers they can, is to be able to offer this work from home, work from anywhere in the country. And so for somebody who wants to go experience Denver, Colorado for 2 years and work for that company, great. But then they can move to Boston,
Yeah.
Massachusetts, and live in Boston for 2 years and experience that and still work for the same company. They're doing remote work, right?
Mhm.
And then maybe they want to go down to Miami, Florida and go experience Miami, Florida. Right? This is just a phenomenon that's not going away anytime
Yeah,
soon.
that's true. All right. So Tony, now let's talk about your current focus. I know you started, building your portfolio with 2 family, 3 family, 4 family, 5. Do you still own it, or now you're totally divested into larger multifamily
No,
properties?
I still own many of the original multifamilies that I purchased. I
Okay.
still own them. I'm pretty much a buy and hold investor. That's pretty much
Okay.
me. However, as I get older, I'm starting to think about, selling some off and bringing it more into like syndications, just because I need the depreciation from the
Hmm.
syndications. So, as we spoke, things change as you age. It's less about the cash flow. It becomes more about the depreciation that you need. So yeah, I still own and to some degree actively manage my own real estate that I own. And then I've also gotten into syndication where I've been an LP, am an LP in deals. I'm a GP in other syndication deals. But most recently, what we're doing, because it's difficult, number one, to find deals, and then there's a tremendous importance these days to be on the inside track and know where the best deals are. So we've actually partnered up with a couple of family offices
Okay.
um, that that have such a great ability to find off-market properties,
Okay.
apartment complexes, right? These aren't onesie twosies. These are like the next one we're closing on is going to be 153 units apartment complex.
Mhm.
And so these are off market. They're in great locations. And so we've partnered with them, but then we've also partnered with RIAs, think financial planner, right? RIA is a registered
Yep.
investment advisor. So we partnered with them in terms of bringing in the cash needed to fund the deal. So we're funding these somewhere, 40, 50, 60% equity. So
Mhm.
our debt payments are low. And so we bring investors into those deals as part of the fund, right? So here you have family office investors, families, right? Ultra high net worth people
Mhm.
who we wouldn't ordinarily be able to invest with. But because we created a fund, we have folks who, are still working a W-2 job who are able to invest like the rich, like the uber wealthy through these family office deals. So we've just partnered up in that way to be able to make it really attractive to find the best properties with the best upside potential for
Mhm.
investors.
You talked about RIAs, right? The advisors, investment advisors. How did that tie up into your fund? Like what what are the
Yeah,
how do you
so
funnel the money from there to your fund to the syndication project?
yeah, so the family offices are a little bit at a disadvantage, only because they do not have, for the most part, they don't have access to the Schwab platform or the Pershing platform, where a lot of investor advisors operate.
Hmm.
So we've created a fund and we have it on the Schwab platform and the Pershing platform. So if somebody has an IRA and it's a self-directed IRA and they want to self-direct that money from the advisor, and instead of investing in Tesla, and they say, hey, Tesla's done well or Apple's done well, I want to get out of stocks and I want to self-direct that into real estate. Now we have a platform on Schwab or on Pershing to be able to funnel those funds right into the fund, right? And be able to then take that, whatever we accumulate in the fund, and then deploy it on a particular asset that we purchase.
Hmm. So you got to register with these different companies. You got to register your fund with different companies. How does that work?
Correct. So yeah, so we have to send in the fund documents to be approved by the
Hmm.
Schwab platform and then also by the Pershing platform.
Okay.
So it's a process. It's a very structured and very disciplined. One of our partners is registered with the SEC, Securities and
Okay.
Exchange Commission, right? He's registered as an investment advisor through the SEC. So it needs to be done in a very structured and approved way. So that's how we've created it. Everything is
Hmm.
legit. It's all on the system. It's all been approved by both platforms. And yeah, so
Okay.
that's how we're doing it, to be able to help more of like the mom and pop investors
Hmm.
who,
Okay.
again, wouldn't normally be able to invest like the uber rich with these family offices, because family offices typically deal with generational money. They deal with
Yeah.
uber rich families, family money.
Yeah.
And so, I wouldn't normally be able to invest with them as an individual, but through this fund, I can, which is a pretty incredible, nice thing to do.
Yeah. That's great, man. That's a nice strategy to have create your own fund and then port it on different portion, Charles Schwab, as well as maybe, I'm not sure, State Street, any other, investment banks.
Yep, exactly.
Maybe I'll have to, we'll get in touch on that,
Yeah, yeah,
talk more about it in detail. Sure.
happy to
Uh-huh.
help there for sure, Ted. Yeah. The more people we can help, I mean, right? This is what it's
Yeah.
about. Where you and I were out there, we're trying to help people, figure this stuff out. This stuff is, there's a lot to it. It can be complex. You study it, I study it. We all get together, we talk about it. And that's one of the beautiful things I love about real estate, right? I go
Yeah.
to conferences and we're talking about so many different things. How do you do permits? How do I do permits? What's the best thing for, attracting, great tenants? What are you doing, Ted? What am I doing? Right? We talk about these things, and I somewhat joke about, you know, if I was in the pharmaceutical industry, do you think if I went to a pharmaceutical conference, people there would be sharing the same trade secrets? Probably not. At a pharmaceutical conference saying, hey, Ted, how do you attract customers? Well, I wouldn't want you to know that. That's a trade
Yeah.
secret that I use, my marketing trade secrets. I don't want anybody else to know. But when we go to these real estate conferences, and here we are, we're talking about stuff and, we're sharing stuff
Yeah.
because at the end of the day, I mean, there's more than enough real estate for all of us. I can't close on all the real estate that's for sale or people have off market. Uh, there's plenty of it out there for all of us. So let's
Yeah.
just try to help each other figure this all out.
Yeah. There's enough opportunities if you have the right mindset, right experience, and ready to put efforts into it.
You got it.
Yeah. So, Tony, tell us something about any one of the toughest thing that you have experienced in real estate so far. You know.
So I think the toughest thing for me personally,
Hmm.
because I'm somebody who I dig in pretty deep. I like to do a lot of the work myself. whether it's research or physical hands-on work. And so early on in my career as a real estate investor, I did too much myself. Um, whether whether I could hire somebody for $10 an hour or not was not in the consideration for whether I did it or not. I just did it because I knew I could do it. And so today I share with folks, it's important to do certain things because there's a learning process that I believe is important and be able to have that experience, but don't do it too long like
Yeah.
I did. That was
If
the
it is
mistake I made.
repetitive, just outsource, get someone else do it. Use your
Yeah,
time wisely on something else.
yeah.
More
Know where
important.
your value is. Like my value is looking at properties, looking at locations, looking at, reports and
Yeah.
different things. My value is not changing toilets and fixing light switches, right? Even though I can do those things, I can do those
Yeah.
things today. I'm very experienced at being able to do, but that's not really where I should be focused, right?
Yeah.
The nice thing is, because I did some of that stuff, I'm able to have the conversation with property managers in a very professional and a very detailed way to have a great conversation to start talking about GFI outlets and start talking about the requirement for smoke detectors and different things I can talk to because I've done it. I have
Yeah.
some of that experience. Uh, but my downfall was I did that for too long. So do some of it would be my advice. Do some of it, which makes sense, which has a low liability, because these days we got to worry more and more about liability type
Yeah.
issues. So do some of it to experience it, to be able to talk the talk, right? You can't walk the walk and talk the talk if you don't have the experience.
That's true. That's
So,
true. Yeah.
I can do it, and I can do it with conviction because I have that experience. But again, don't do it as long as I did it. Move on, take that experience, put it in your, in the bag that you carry, and use that going forward in conversations. But figure out where you add the most value
Yeah.
to the deal. Sometimes some people are very much spreadsheet jockeys and they're great at spreadsheets, and that's great. Don't get paralyzed doing that. Do that, perfect it. Um, and if you're not really the right person to go get your boots dirty, walk in a property, maybe partner in the form of like a limited liability a company, partner with somebody who is really good at walking the property and looking at it and noticing what issues might be there and where you can negotiate to reduce
Yeah.
the price and where the value add might be there to increase rents, right? Partner with somebody, right? If you're a spreadsheet jockey, that could be very great because underwriting a deal is super important. You have to
Yeah.
know spreadsheets and how to maneuver and how to do the calculations.
Yep.
But yeah, there's a lot of different ways to do real estate today. So yeah.
No, no, that's true. If you don't know something, just partner with someone whom you know. I always give that advice to any to our listeners as well as anyone whom I know, who wants to get into real estate. Uh,
Yeah.
because I did the same way back in like 2012.
Yeah.
I didn't knew nothing about real estate, and I started working for free for one of my or for a person whom I know who was in the construction business. I just worked for free for 6 months, got an experience, and then I started my own venture.
That's great
Yeah,
advice. That's great. I think people, they put so much value on selling their time for money, right? Because that's what we're taught. That's primarily
yeah,
what we're taught from our parents, from the school system, to create, some sort of value for yourself that then you go sell your time for money. Whereas I
yeah,
love this idea that you just mentioned, where you go work for free to be
yeah,
able to add more skills to your toolbox, more tools to your toolbox, so that you become now more valuable to your investors, right? To your partners,
yeah.
because I mean, it's not working for free for 6 months. You're getting an education,
Education, free education.
right? Which
Yeah.
is super valuable.
Yeah.
Good for you. Great point,
Yeah.
Ted. Yeah.
All right. So, Tony, what would the advice that you like to give to a listener who wants to get started in real estate the way you did? What are the steps that you want them to take?
Yeah, so I would say no, number one, find a mentor or a coach. There's a lot of them out there. Find a reputable mentor or coach who has done what you want to do, right? There's folks who, want to get into self-storage. I don't do self-storage, right? But that's okay. I know people who do self-storage. I've referred so many people to some different folks who do mobile home parks. I don't do mobile home parks. It's just a different model. So find that person who is doing what you want to do, right? If you want to grow your short-term rentals, VBRO or Airbnb, if you want to do short-term rentals, go find somebody who's like doing a great job at that and go, seek out mentorship or coaching from them. That would be number one. Careful of social media. There's a lot of folks out there who are, again, they're showing beautiful houses and Lamborghinis and, you know, I mean, a lot of wealth has been made in the last, easily 10 years, if not 15 years. There's a lot of folks out there who have not seen a bad market, a downturn in a market. And if they haven't seen that, um, I think it's going to create a lot of opportunities for
Yeah.
for new people. But yeah, just find somebody who's experienced a little bit of both, good times and bad times, because those folks are going to help you navigate through a lot of different risk scenarios, so you can be profitable in this.
Awesome, Tony. Hey, loving this conversation, but I would like to be mindful of your time also.
Yeah,
So would
thank you.
like to switch to the final round of questions. Are you ready, Tony?
All right.
Okay. All right. So which is the one book that you'll recommend that had the most impact on your life or on your business?
The number one I recommend quite a bit is a book called Who, Not How. It's a
That's
book
a
by
great
Dan
read.
Sullivan.
Hmm.
It's a very easy book to read, storybook format, and it helps us all calibrate to, we don't need to know how to do everything. As an engineer,
Yeah.
classically trained and started off my career as an engineer, I was always trained and calibrated to, I needed to know how to do everything myself. And that's not true when it comes to real estate investing. You don't need to know how to do it all. You just need to know the who's, right?
Yeah.
When I go and I create an LLC or something, I I don't create those operating documents myself. I go to my attorney, who's a real
Yeah.
estate attorney. He's great. He does all that stuff. He went to school for years to learn how to do that. I'm
Yeah.
not the expert. I rely on the who's to do that work.
Yeah. That's a great read. I love that book too.
Yeah,
It's one of my favorite too. All right.
excellent.
Yeah. What are your main source of information to learn and grow?
So strictly with real estate investing, I like certain podcasts that share value. I don't get caught up in like, CNN or Fox News. I mean, some of that becomes entertainment television. I'm really here to grow myself, grow my wealth, grow my freedoms. So in doing that through real estate, I rely on listening to, different podcasts and YouTube channels are great these days because
Yeah.
there are some great. You got to pick out the great ones. Some of the ones I like is because I know you have a very vast audience. I like Bigger Pockets. I
Yeah.
think that's a great site to look at. They give a lot of different information, and depending on if you're in short-term rentals, they talk about that. Syndications, they talk about that, or multifamily active investing, they talk about. So you can find a little bit of everything with Bigger Pockets. So I
Yeah.
like that. Um, I also like, individuals like Ken McElroy.
Mhm.
He's a very popular one out there. He talks not only just about the multifamily space, but he also talks about macro environment things, big picture things. He also talks about renter nation and different things, right? So he talks more macro, in addition to some multifamily stuff. So that's what I like about his channel. So there's two which offer plenty for your listeners to go seek out and start listening.
All right. Next question. What is the best business or investment advice you'd like to give to our listeners?
Well, we spoke about it a little bit already. Is the best advice I can give is, find somebody who's doing what you want to do, whether it's a business you want to start or real estate investing you want to go do. Go seek out that person and go hire them as a mentor or as a coach. Go sit down with them. Go buy them a cup of coffee, right? Go find that person who's already doing what you want to do.
Yeah.
It makes it so incredibly easy when you're able to do that. And let me tell you, the folks I've sat down with, like that I've found as mentors and coaches, they're always so helpful and happy to share that knowledge to make it easier for the next person to do what they've done. So there's never any like, oh, you're going to steal my trade secrets or anything like that. It's not like that. Go find out the best person you can who's doing what you want to do, and go buy them a cup of coffee.
That's a great advice. All right. A final question, Tony. How can Decoding Cashflow listeners get in touch with you?
If they want to find out more, they can just go to my website, dirtybootscapital.com. They can look around there. They can shoot me an email as well. Real easy. Tony Lopes with an S, Lopes, Tony Lopes at dirtybootscapital.com. I look at all my emails. I respond to all mine. And so it's nobody else. So you'll get yours truly when you send me an email.
All right. All right, Tony. It was a pleasure having you on the show. I had a great time, and I'm sure there are not many advice, golden nuggets for the listeners to take back and act on it.
Thank you for having me, Ted. I appreciate it.
All right. Take care. Bye.
Bye-bye.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.